Three more stocks trading around 52-week lows. Let's analyze them and I'll give you the best entry prices for each stock. Right off the bat, I should tell you about my process. I pay 1 PE for 1% of their margins. I prefer using the lowest band of their margins as my basis for their fair values for my margin of safety, and so I can position myself for a higher return on my investment. You could buy the stock for their free cash flow or equity basis. I just prefer PE when I'm dealing with these kinds of stocks. First stock is VFC. This is their valuation summary. This is still rich in multiples. For my liking anyway, I think there's more downside to this stock. I prefer 6 as my PE. You could use 10 if you want, but that leaves you without margin of safety and you'd get minimal return on your investment. This is still trading expensive at 4.03 times their margins. Free cash flow is negative right now, but their equity is well within my allowable PB of 5. I'd be worried about those dividends and their debt levels if I were you. This is almost a cyclical market. Looking at their EPS history, good thing is that they're buying back shares. I have fair value around $7. Go to Focus's intrinsic value is $25. I suppose this is their fair values if I use their EPS back in 2020 of 3.53. Yep, you get around those prices. But again, it's not worth $25 because the EPS is not 3, it's 1. Let's look more into this stock. While revenues remain strong, 4 quarters of declining free cash flow and equity would explain this stock performance. These black lines you see here are my fair values for each quarter. This is PE of 6 multiplied by the EPS trailing 12 months. Orange lines are dividend yields. If we're talking valuations on earnings perspective, then the stock is still expensive. But on the equity side, you could argue that the stock is cheap. One thing though, buyers in this quarter are overpaying. Just look at the fundamentals from last quarter. It's cheaper then compared to now. I guess bullish buyers are looking for a positive earnings next quarters. But the way you see it and analysts forecast things, it could still fall and make new lows. This quarter, I have a fair value of about $6. There's an interesting price level to watch if you're confident VFC would be profitable next quarter. That price is around $20. That's my previous fair value. If you think that the EPS they reported in these quarters here are an anomaly and you see VFC being profitable next quarter and next after that, and they would report reasonable EPS, then the $20 should hold. But again, I don't forecast things. I like it when the stock is below my fair values. If you're bullish long term for VFC, I think a deep buy at 20s would be reasonable. But keep in mind that it's not necessarily the bottom because the EPS is lagging the stock. I wouldn't recommend buying the stock just yet. If you're looking to DCA, probably $20, but don't go big. Just add a little, then let's see where their financials would take us. Next stock is JWN. This is their valuation summary. Historically speaking, it's cheap now, but the stock is still expensive, trading at 9 times their margins. This is a low margin stock, and I'd only recommend buying this stock cheap. I prefer 4 PE, but I have reservations about that. Since this 2021 drop in their financials, their margins have been like a grocer stock with margins ranging only from 1 to 3%, which is not good for investors, especially when you're moving big money because it will take a long time to get your money back. But if JWN could go back to their past state of having 4 to 6% margins, then I'd use 4 PE as my fair value here. Now, this is just me being open to the idea, okay? Anyway, even if I use 4 PE here with the current EPS, the price is still expensive. EPS growth is cyclical, but they're buying back shares, which is more important. And they actually reduce their dividends to reduce costs and raise more money. Although it's overvalued, I have it on hold. I wouldn't recommend buying or DCAing at these prices. If you're still in profit, I would sell. Here's their charts. I think I'd put an alarm at around $12. Let's see if it breaks the COVID lows. Personally, I think it will, but I would never short. My bias is to only buy. I don't like paying for borrowing shares. These black lines you see are my fair values for every quarter. This is 4 PE multiplied by the EPS during 12 months. I want to see the stock price below my fundamentals before I even get interested in this stock. This quarter, I'm looking below $8. Next and last stock is KSS, trading at 2 times their margins and only 0.75 times book. Earnings-wise, it's expensive, but equity-wise, it's cheap. If you believe KSS would still be profitable in the coming years, then yes, this is the time to get interested in the stock. No, I'm not saying you buy now. I'm saying you keep an eye close to this stock. If you look at these charts, it's now hovering at my previous fair values. My fair values PE is 4, and the price I'm buying KSS this quarter is $16. I'd put this on my watch list definitely. If you're okay buying at fair values, buy at $16. I don't recommend buying at fair values. I want it to overshoot below my fair values. Also, you might want to look at this analyst's forecasts because if this were true, the stock would fall cheaper, down to around $10. That's it for the 3 stocks. I think KSS is the most interesting stock here. There's a lot of information in my videos and I know it might be hard to understand at first glance. I suggest you pause and understand what's written on it and understand how it would help you trade these markets. Again, subscribe and visit our Patreon for deals. See you next video.